Hello dear traders, the US stock market has just wrapped up another successful trading week. For a moment it seemed like the market might undergo a correction, but this idea quickly receded to the background. This week, the last one of the year, is unfolding in the Christmas period. Wall Street is anticipating the so-called Santa Claus rally, which is expected to bring record highs as the markets close to 2023 with significant growth. The S&P 500 index has risen by over 4% in December alone, marking a 24% increase for the year. Historically, this momentum is likely to continue in the short term. The end of the year is typically a strong period for stocks. Stay tuned, the financial world is always full of surprises and interesting events. Watch the video till the end and share your thoughts in the comments below. As for the US Federal Reserve, the key event next year seems to be the policy of cutting rates. The annual rotation in the rate-setting committee points to more assertive members in 2024 compared to the outgoing group in 2023. However, this doesn't alter the forecast of an upcoming easing of monetary policy. In fact, many analysts express the opposite view. If inflation decreases faster than expected, Fed members might show even greater willingness to cut rates. This could exceed the 0.75 percentage point forecasted in last week's projections. Recent crucial consumer price index data only strengthened this viewpoint. Both key and core measures decreased more than economists predicted, leading annual rates for the past 3 and 6 months to fall to or below the Fed's 2% target. In the second half of the year, the Fed became more dovish as signs of easing inflationary pressure and a cooling labor market emerged before the rate hikes from March 2022 to July 2023. Notably, policymakers who previously supported a hawkish stance, including Fed Governor Christopher Waller, have backed off from their earlier support for rate hikes. This backdrop contributes to a rally in risk assets. The correction that began on Wednesday in the US stock market did not continue. After a 1.5% dip, the indices recovered over 1%. The upward trend proved extremely strong. Even the high level of market overbought conditions does not allow bearish players to make any significant headway. Thus, the 8th consecutive week of growth has concluded. In 2 months, the indices have increased by over 16%. Dow Jones has successfully updated its historical peaks, and both the S&P and Nasdaq have set new annual highs. The only observable trend is a slowdown in growth pace due to overbought conditions and proximity to technical resistances. The Dow Jones ended the past week nearly flat. Overall, it's worth noting that the indicator reached a new historical high, surpassing the 37,200 mark. Nothing seems to hinder it from maintaining this level. The fresh impulse has pushed the Dow Jones into the overbought zone. Since late 2007, the market has experienced similar overbought conditions only 3 times: in December 2016, October 2017, and January 2018. In the first 2 cases, a spike was followed by more than a month of horizontal consolidation, then a sharp rise. Only in the third instance did a subsequent 2% rise over 5 sessions lead to 12% correction. Despite extreme values and obvious overbought conditions, investors should now be cautious in their forecasts about a rapid decline in indices. The S&P rose by a symbolic 0.4% of the week. For 2023, the index has grown by 24%, with only 1% left to reach the record high of early 2022. The broad technical picture suggests further growth of the S&P index with the possibility of updating historical highs above 4,820. The question of whether market participants can conduct a correction remains open. Intervening in a counter-trend strategy inherently carries risks, so protective stops should be kept handy. An important support in case of a downturn is the level of 4,600, and after surpassing their record highs from January 2022, there might be a temptation to reach the round mark of 5,000. These high levels are likely to become relevant in early spring 2024, especially if the Fed begins to lower the key rate. The Nasdaq 100 gained almost 1% of the week. The index remains at peak values. Since the beginning of the year, the Nasdaq has confidently maintained leadership among all global stock indices, showing a gain of 43%. This impressive result is due to the high sensitivity of the index components, representing growth-oriented companies, to interest rate changes. The monetary factor provided by the Fed will continue to fuel euphoria in the market, and it's highly likely that the technology index will reach its peak closer to spring. Over the last 30 days, all three indices have shown impressive growth. During this time, all 11 sectors of the S&P have risen, showing a so-called universal rally. This scenario was unexpected, given that for most of 2023, investors were concerned about inflation, interest rates, and an impending recession that always seemed close. Nevertheless, in the final weeks of the last quarter of the year, investors are actively buying stocks, bonds, cryptocurrencies, and gold. Regarding stocks, Bloomberg named the fastest growing companies in the S&P, with Nvidia topping the list. There is no doubt that 2023 will mostly be remembered as the year of generative artificial intelligence. Its dominance is unlikely to lose relevance in the new year, making the purchase of shares in companies like Nvidia a promising instrument. Nvidia stocks are far from reaching their potential peak. Despite many speculations about whether Nvidia can maintain its current growth trajectory, it's hard to expect a repeat of this year's 235% increase in stock value in 2024. However, a successful investment doesn't necessarily imply the same percentage growth in shares year after year. Forecasts indicate that Nvidia shares still have much potential for growth. It's expected that by 2026, the shares could grow by approximately 120%. Therefore, newcomers can more than double their investments in the next 2 years by investing in Nvidia shares today. And we continue to monitor the stock market situation to keep you abreast of the latest events. Subscribe to our channel and leave comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.